Hello, Ed Yardeni here on a nice, bright, sunny day in Long Island. I hope it's bright and sunny where you folks are. Max is sleeping over there, so if you hear somebody snoring, that's Max. Likes to be here during these conference calls. Lots to talk about. Clearly, this is the beginning of the second quarter earnings reporting week. This is the week in which companies start their earnings reports for the second quarter of this year. And it'll be quite interesting because as you know, and as I've been saying along with Joe, we've had a very interesting market in the first half of the year, a very difficult market. But the reason it's been difficult is because investors have lost their confidence in analysts' heady bullish earnings expectations and have whacked the valuation multiples of the S&P 500, 400, 600. Any stock that's out there in any market, we've seen a tendency for the PE ratios to come down dramatically. And that's at the same time that analysts have been actually raising their estimates for this year and next year. And as a result, the time-weighted average of those two forward earnings based on forward revenues have continued to climb to record highs. So we'll see. The second quarter earnings season will give us some insights, I suppose, on who's right. As you know, I've been writing that analysts are from Venus and investors are from Mars. So we'll see who's got it more right. But it really doesn't matter. At the end of the day, don't fight the market, don't fight the Fed, well, don't fight the market. And if investors are worrying about a recession, worrying that analysts are too optimistic, they obviously have the final word in terms of what they're doing with valuation. So what are some of the issues that we'll be looking at during the current earnings season? I think companies are certainly going to be addressing the recession issue. I think for the most part, they're going to confirm that there is no recession in their business. Their businesses are still growing and that they are seeing their revenues not only going up because of unit sales, but even more so because of rising prices. And so revenues are, it's not surprising they're all-time record high given that inflation has surged. What has been surprising, of course, is earnings. So we'll be looking to see what company managers have to say about earnings. Will they be saying that the profit margins are holding up at record or near record highs for many of them? That's what the indications are from the analyst expectations. And so we'll be looking to see whether they're saying that the earnings have increased during the second quarter on a year-over-year basis in line with revenues, which would imply that profit margins have held up remarkably well and would imply that companies are doing a great job of passing through their cost increases, dealing with labor shortages, dealing with supply chain disruptions in a way that still allows them to pass through all those costs and all those problems through into prices. So that'll be important. Clearly, the dollar will be an issue for multinationals. And that's not a good issue. We know that the strong dollar is going to be hurting some of the multinationals. So that's something that the markets may or may not have discounted. Microsoft, I guess, a few weeks back announced that they were seeing the dollar cutting into their revenues. So it's not going to be a total surprise to see that that's the case. Supply chain disruptions, I expect we'll be hearing that they're abating. But what the markets will be focusing on and what we will all be focusing on is as the supply chains easing. We've heard about freight shipping rates coming down sharply between China and the United States. We haven't heard much about that happening in trucking in the US, though anecdotally I'm hearing a little bit more in that direction than the direction that things are getting even tougher. But the question on supply chain disruptions, I think we'll still raise the question of whether that's because they're fixing some of the issues that disrupted the ability to get parts, and to make deliveries? Or is it because the global economy is slowing, in which case it's demand that's easing? Obviously, one of the reasons we have these supply chain issues has been that we got a supply shock caused by a demand shock, way too much demand stimulated by overly stimulative fiscal and monetary policies, to a large extent that causes supply disruptions. But there were also a lot of other issues related to that. And maybe those issues have been fixed. But meanwhile, if demand is slowing, that obviously has a negative impact on our thinking of where things are going in terms of earnings over the next few quarters. Inventory issues will be important, particularly among retailers, and odds are they will report, confirm as Target reported at the end of the first quarter earnings season, that inventories are a problem, that consumers have responded to higher food, fuel, and rents by being forced to cut back in other areas. Some of them may have dipped into excess savings, but for the most part, consumers, especially low-wage consumers, have been really squeezed by the rising cost of essentials, and they've had no choice but to cut back on discretionary items. And better off consumers, to the extent that they've already dipped quite a bit into their personal savings, may decide that they've bought enough in consumer discretionary items. So the inventory story, particularly on consumer discretionary items, will be interesting, and we'll probably get some reflection of that in Wednesday's CPI report and find that the durable goods CPI inflation rate has moderated. But some of that will be offset by food and fuel costs being a problem still in June, which will be the June CPI. We are seeing, obviously, the easing off in commodity prices for food and energy over the past several days, and that'll be reflected in July CPI. So looking beyond June CPI, there's some reason for expecting that weakening durable goods prices and some easing off in these commodity-related expenditures by consumers will make it increasingly look like inflation has peaked. But on the other hand, we'll have things like rent, airline fares are off the charts and probably remain off the charts. We've been looking at scheduling some vacation time, and the fares are extraordinarily high. What else? I think clearly geopolitical concerns will be addressed by company managements, and those concerns will, I guess, revolve around China and its zero COVID policy and how that's depressed the Chinese economy. And again, we had some indications that sales of cell phones in China have slowed. On the other hand, Samsung recently announced that they're still doing fine in terms of semiconductor sales and all that. I think for me, a big issue is Europe. The news is getting uglier and uglier in terms of the consequences of the Ukraine war on Western European economies, as we know that Russia is about to shut down its gas pipeline, presumably for maintenance, but there's apparently a lot of trepidation that it may not reopen. I don't know why the Russians, unless they really just want to do a real nasty tit for tat for what the Ukrainians, what's going on in Ukraine. I mean, they do need the revenues, I would think, but Putin may want to up the damage and the pain that the Europeans are experiencing by supporting Ukraine. And there's a lot of talk about a significant energy crisis, more than what they've got right now, in the event that gas just doesn't flow out of Russia. Germany, France, Italy, they all depend on this gas. And it may seem early to say winter is coming, but winter is coming. And to the extent that Europeans have to prepare for it, they're already scrambling to get gas into their storage facilities. So there's putting a lot of upward pressure on gas prices and electricity prices. And that could very well create a very significant recession in Europe with a lot of financial repercussions. So, if we're going to have a real calamity here, it's not going to be something like the great financial crisis that's had an epicenter in the US housing market. it would be a much greater concern of how a severe recession in Europe creates problems for the rest of the world. China certainly would be hurt by reduced exports to China, to Europe. So would the United States, reduced exports to Europe. And then the financial consequences are something to be considered. So as you can tell, we're thinking a lot about it. We're researching it, and we're going to be monitoring it very carefully. Let's turn to some of the charts here. Let me know if you're not seeing them. I had one incident a couple of weeks ago where we had a problem with the charts, but hopefully you're seeing them. You can send me, let's see. Okay, we're starting to get some questions, which shows that at least the audio and video is getting through. So let's look at these charts. The issue obviously has been recession. Lots of issues that are going to be discussed in the company reporting season calls. But first and foremost will be, are you seeing or aren't you seeing a recession in your business? From a macroeconomic standpoint, it's a mixed story right now. We've got leading economic indicators, as you can see in the red line here, looking kind of toppy. We know that 5 of the 10 components of the leading economic indicators for June are down. So June is going to be down. So I think that'll make it 6 months in which the trend of leading indicators have been to the downside. It would make 4 consecutive monthly declines. And one rule of thumb, a popular rule of thumb, is that 3 consecutive declines on a monthly basis is a clear signal of a coming recession. But as you can see in these numbers below here, if you average them all together, you get something like the peak in leading indicators on average tends to occur about 12 months before a recession actually unfolds. And you can kind of see here's the peaks, and then the subsequent recession. So that's that says that even if this it did peak 5 months ago, that would still give us a few months before we get into an actual recession. But the market looks ahead, and maybe that's what the market's been seeing. But meanwhile, there's absolutely no recession in the index of coincident economic indicators, which includes things like payroll employment, which on Friday continued to rise. As a matter of fact, private sector employment was an all-time record high. On the other hand, household employment, which is not a leading indicator, has been kind of moving sideways. Personal income, adjusted for inflation, is a coincident indicator. And the data that came out on Friday for employment, for wages, suggests that there was a pretty decent increase in personal income in nominal terms. The problem is that for the past year, these solid wage gains and employment gains, the resulting increase in personal income has been eroded by high inflation. And so we'll see how that plays out, but that's one of the 4 coincident indicators that's kind of been moving sideways. And then, of course, there's industrial production, and there was some data on Friday in aggregate hours worked in manufacturing that showed that that's actually coming down. So there is some signs of weakness here. As I said, the payroll employment number, all in all, we continue to have a solid recovery there. If you look at that number, the households sideways, labor force sideways. So that's something to consider as not as spectacular a report as was widely thought. Meanwhile, the deterioration or erosion of purchasing power, you can see that here. Again, on Friday, we had real average hourly earnings. That's for production and non-supervisory workers. So that's about 80% of the labor force, and it's, let's call them lower wage workers, though they're really not lower wage, but relative to the other 20%, they are. The 20% of higher wage earners get about $50 an hour, and the production and non-supervisory workers get about $25 an hour. They've actually had bigger wage increases than the higher wage workers, but they've all been eroded, as I said, by inflation. So here you can look at the inflation-adjusted wages of production and non-supervisory workers, and they've been going sideways. That hasn't necessarily violated the underlying trend of 1.2% per year, which is consistent with the growth in underlying growth and productivity. And that's still our story once we get through this environment that we're in right now, which could take another 6 to 12 months, obviously. This is the great inflation of the 1970s versus the roaring 2020 scenario. Right now, it certainly looks like the great inflation of the 1970s, sort of on a fast forward, in a fast forward manner. So here is real personal income. We can see that that's been going sideways when you look at underlying core real personal income, excluding government support programs. That's by way of getting us to this earned income proxy that Debbie and I calculate every month when the employment numbers come in. And as you can see, the earned income proxy in nominal terms looks pretty good. It was up 0.6% on a month-over-month basis. But as you can see, when you look at the data through May, because we have the consumption deflator through May, despite all this decent increase in nominal, real has been barely increasing. And that's weighing on the consumers. And consumers have been able to maintain some of their spending on spending by dipping into their personal saving. But we may be running out of some of that juice. And we may want to focus on this as a source of slower consumer spending. But there's no recession yet in the consumer spending numbers. Let's get to the bottom line and all that. Meanwhile, when we look at what the Fed is up to as a result of the employment numbers, the Fed is certainly going to continue to proceed. Is going to proceed with its plan to raise the Fed funds rate by 75 basis points at the end of this month. And as you can see, this is the 2-year yield versus the Fed funds rate. And the 2-year yield has finally started to slow down. It was just kind of going straight up. And now it's kind of been going sideways around 3%. So there are some indications that the markets are starting to signal that even though the Fed hasn't done tightening, its guidance has led to a tremendous amount of tightening in the financial conditions. Certainly in the housing market being one clear standout, and that's slowing the economy down, and that is increasing the risks of a recession. There's a little some work I've done. We did in the morning briefing on the S&P 500. It's one of the 10 leading economic indicators, and its relationship to the business cycle is something that we took a look at. And if this was a top that's a good leading indicator for a recession, the average time between a peak and a recession is 5 months. So it peaked in February. So we, according to this indicator, we should be either in or imminently falling into recession. Where do we stand? We stand on our view that now where the risks of a recession have increased from 45% to 55%. A lot of that was based on things like the Purchasing Managers Index and the regional indexes weakening, the consumers spending slowing on consumer durable goods. And so it's not inevitable, but it does look like something in the neighborhood of a growth recession or a mid-cycle recession. It may turn out that this never gets a blue shade the way things are unfolding. The consumers' balance sheets are still good. The corporate balance sheets are still in good shape. Inventories are being managed, so they picked up here. Now they're being liquidated, which could help bring down inflation and reduce the maximum Fed funds rate that the Fed's going to have to go to achieve what it wants to achieve. So meanwhile, we've been in a bear market. Now I don't know what we're in. We're up 18%, but officially speaking, we saw that through June 16th, we are down 23.6%. And we got down to 3,666 on June 16th. So just for fun, we're kind of watching the Da Vinci Code as a possible indicator of a market bottom. It was on March 6, 2009 that we got down to 666. and that turned out to be a Da Vinci Code bottom. It was a devilish number. I'm kind of hoping that 3666 was it. I'm not a symbolist. Joe and I are fundamentalists, and why might that have been a bottom? Well, ever since then, we've seen the bond yield looking kind of peakish. At least it's back down to closer to 3% than 3.5%. We've seen commodity prices coming down. That indicates that inflationary pressures may be coming down. And the market looks ahead, and the market may increasingly be looking past the second half of the year into next year. And so even if we get some downward earning revisions in the second half of the year, investors increasingly are going to be focusing on next year, and next year might increasingly be looking pretty good. With the one thing that I'm concerned about is the European situation. So we'll be watching that. Meanwhile, for the here and now, this is analyst consensus expectations for earnings on a quarterly basis for the S&P 500. And as you can see, there was a slight downward revision in that number for the second quarter as a result of the first quarter's results and guidance. And despite some negative guidance we've gotten on the dollar and on inventories and things like that, the expectations have actually been kind of flattish. And there is a tendency for expectations to be too pessimistic going into earnings season. So maybe that's we'll see some improvement there. That's the growth rate. So the expectations are that earnings will grow 4.9% year over year in the second quarter. They did grow 11.6%. And before the first quarter earnings season, they were expecting 5%. So that was encouraging. Again, the analysts are apparently on another planet from where the investors are. And you can see that through the end of June, we had forward earnings at an forward revenues at an all-time high. And that's a pretty good indicator of actual revenues. And then, of course, we've got forward earnings at an all-time record high. And that's a pretty good indicator of forward earnings. And the profit margin is remarkably, according to the analysts, holding up at a record high here. So we'll see the extent to which the earnings season changes any of those expectations. I had a question from one of our accounts wondering whether all this good news on forward earnings is all just nominal and not real. And so we did run this chart of nominal divided by the CPI, nominal forward earnings. And you can see it looks pretty good. It's been a very solid recovery. And so the underlying strength in real earnings has been quite good. When you look at the growth, year-over-year growth rate, there is a deceleration in growth, not exactly a tragedy here when you consider that real forward earnings are an all-time record high. But as you can see, the nominal is up 18.4%, and a lot of that is inflation, but not all of that. 10.8% is real, but there is a cycle in this thing. And the question is whether this cycle is heading towards major negative territory the way we did in previous recessions, or whether it's going to be something more mid-cycle, kind of like here and here. And Joe and I are inclined to think it's more mid-cycle kind of stuff. So with that, let me stop sharing, even though sharing is caring. Let me take care of your questions here. What are some of the market bottoming signs or indications? Can you provide a write-up, please? Well, I think probably the most consequential or historically the most interesting signs of a bottoming is the extreme pessimism that we've seen in sentiment. The bull-bear ratio, for example, a couple of weeks ago was down to 0.6, which is the worst it had been since that week, March 2009, when the market hit its intraday low of 666. So I think sentiment has really been among the most bullish indicator to the extent that it's been so extremely negative. I suppose we'll be looking to see in this earnings season for guidance on whether we are going to see substantial downward revisions in earnings. And that might be telling, might give investors more confidence that companies are in fact doing relatively well in this environment, and that might help. But let's face it, don't fight the Fed is still been the key issue here for the market. since the beginning of the year. The Fed's been fighting inflation. So it's not just don't fight the Fed, it's don't fight the Fed when it's fighting inflation. When the Fed's fighting inflation, the market goes down, as we've seen. But the question now is whether the market is starting to sniff out a bottom, and that will depend on the inflation indicators. And right now we're looking at some weakness in commodity prices, indicating global economic weakness. We're looking at some significant weakness in shipping rates between China and the United States. So there are some leading indicators of inflation that suggest that it's moderating. And to the extent that that's the case, then the market at some point might conclude that we've discounted enough of tightening, and there is some indicators suggesting that the markets are starting to anticipate that the Fed will be easing next year. But that's the good news, bad news. Is it going to be easing because inflation moderates and the economy is still growing, or is it going to be easing because of the economy is in a bad recession? We're in the economy is going to continue to hang in there without a hard landing, maybe a soft landing, maybe a mild recession that doesn't make the history books as an actual recession. But we're thinking that 3.5% is about it on the Fed funds rate, probably more like 3. And if that's the case, because inflation moderates, that would help make a bottom for the market. Okay, that was from Jay. Anonymous asks, do you think Chinese economy will loosen after Xi Jinping is reappointed in November? Will this help global GDP? Well, the Chinese have actually seem to be moving towards another stimulus program, loosening up some restrictions on bond issuance by their provincial governments. The provincial governments have been badly hurt in their finances because one of the major sources of financing in China has been to sell land to developers. And there's a very significant housing recession over there. I think it's as bad as it was here in 2007, 2008. They're just better at hiding it and managing it, I suppose. But the provinces aren't having much success selling land at this point to developers who are mostly bankrupt. And so that being the case, they are in desperate straits. And I think the Chinese government is moving towards allowing them to issue a lot of bonds to finance more infrastructure projects. That, I guess, is stimulative, though. I don't know that more capital spent on more infrastructure is what China really needs. Sheldon, parity of euro to the dollar has been the expected low. Do you have a view of what the euro could do relative to the dollar, assuming a larger recession in Europe versus in the US? Yeah, I think it could go under parity in a really bad recession. I mean, the Europeans made a tragic mistake, and a near fatal mistake, in becoming so dependent on Russian gas and oil, particularly gas, because oil is a global market and it's fairly easy to get. Gas is a global market, but it's also a local market. It needs to be delivered by pipelines, and that's where the issue lies right now. And it's going to be a real going to be a difficult situation, and increasingly it looks as though Europe is going to have a pretty nasty recession in the winter months as a result of this energy crisis. If that's the scenario they're heading towards, the euro's going to go lower, below parity. The question is, how bad is that going to be for the rest of us around the world? And it's not going to be good. But I think of all the countries in the world that are probably in best shape to deal with all of these geopolitical crises that we're confronting, the U.S. is probably in the best shape right now. And I think that's one of the reasons the dollar is doing so well. Okay, Scott, average maturity of U.S. debt is roughly 3 years. Current net interest expenses is around 434 billion. With 30 trillion in U.S. debt, every 1% increase in rates equals 300 billion of additional interest expense. I don't see much commentary about this. One would think that this puts a cap on how high interest rates can go. Well, it's a very good point. We've addressed it kind of occasionally. I'll address it again. I think Wednesday, the federal budget comes out again on a monthly basis. So we'll see how that's shaping up. We'll look at the net interest component. But what's been interesting is inflation's very good to the king, as long as the king doesn't get beheaded. Kings can go ahead and spend and create inflation, but if they create too much inflation, the popular folks start to rise up. In this case, inflation has been very good for government revenues, and government revenues have really soared. So the offset to higher net interest payments by the government has been even better revenues as a result of inflation. So it's not that simple, in other words, but we'll have another look at it. And right now, that's the simple answer, is that net interest costs are going up, but they've been offset by higher revenues, and both of them are inflation related. Take a couple more questions. I'd like to keep this to half an hour. Headline CPI expected is 8.8%. What is your opinion? Same thing, 8.8%. I don't really have any argument with that. Question is sort of the makeup of all that. I think we can extrapolate that come July, the food and energy inflation will moderate some. But we'll have to look at the rent inflation measure, because that's definitely going to be an offset. John, can the Fed get inflation to its 2% goal or even 3% without a recession? There's no way they can get to 2% without a pretty significant recession. We're looking for 3 to 4% on the inflation rate, the PCED inflation rate next year. And we think that's about as good as it's going to be able to get without a significant recession. And a lot of that's because of what the Fed managed to accomplish in terms of providing ultra easy monetary policy. It led to extraordinarily high home prices. And now with mortgage rates up, we're looking at rent inflation that's significant and likely to be a real problem for the next 18 to 24 months. So in that kind of time frame, it's hard to see how inflation comes down to 2%, and I think 3 to 4% is it. I won't be surprised if at some point along the way, the Fed actually announces the 3% as they'll move the goalpost, the 3% as their target rather than 2%, as I've discussed in the past. Let's take this last one. Do you believe this is from Willem, do you believe US inflation can get down to 2% target in a sustainable manner without a true recession? Okay, so that's the same question we just had. Somebody's trying to call me on Skype, and I'll shut that off. Well, somebody's trying to call me on Skype. Why don't I say thanks very much for tuning in. Let's do this again next week. Have a great week. Bye-bye.